high-level vision that we're going after is trying to actually blend the line between private companies and public companies. And that goes to reporting and communication. That goes to access for investors in these companies. And also goes to liquidity. So there's very little liquidity in the private markets, lots of liquidity in the public markets. So how can we kind of bridge the gap between those two very distinctly different worlds? So I'm gonna ask you all about each of those topics. So without further ado, I do want to bring up to the stage. So we have Ed Antoian from Zeke Capital Advisors. We have Mike DiPiano from NewSpring Capital. We have Howard Ross from LLR Partners. And we have Gina Moore from AJO Vista. So please welcome up to the stage. Over 20 years, there's been a decline in the number of IPOs that have happened, and then all of a sudden there's been a burst of IPOs in the last couple of years. Gina, maybe I'll start with you. So obviously that affects you as a public equities manager because there are fewer companies entering the public markets. So I guess just to start, how do you think about IPOs? Do you ever participate in IPOs? And is the valuation, I know the valuation is obviously fundamentals and valuation is very important to you. Is that, is that affecting the way that you're looking at freshly IPO'd companies?
Sure. In my new venture at AJO Vista, we're in the micro cap market, and it's really my first time being that far down the cap spectrum. Typically, over the last 25 years, I've been more focused in small and mid companies on that end of the spectrum, and purposefully avoided IPOs. They didn't typically make it into our investable universe. But in the microcap space, we have that opportunity. The challenge for us is about the transparency of information as a quantitative investor. So it's something that we demand. We have to have it for comparability. And what we find is that even if we have enough information in the IPO market, the issue around what happens during the lockup period and what we can or can't see in the emotion of that IPO, we typically tend to wait. So for us, the opportunity that gets provided in a rich IPO market is typically at a lag relative to what's happening at the very beginning of that market.
Gotcha. Yeah, so that goes back to the reporting that, how much look back do you have on all of that?
Yeah.
And so this one's probably for Howard and Mike. So the IPO market is probably an exit, in some ways an exit opportunity for you both. And I suspect you may bring up SPACs and direct listings because those have definitely been in the news a lot. Are you seeing within your funds IPOs or SPACs representing exit opportunities, or are you not really participating in that area?
Yeah, just a couple thoughts on that. Am I coming through okay? First of all, in IPO, the recent trends, if you're as old as I am and you look back to the 60s, there's been tremendous peaks and valleys in the IPO market. 1969 was probably the greatest year in the history of the country for IPOs. And then the 70s was probably the deadest decade in the year. Some years there were 15 or 17 companies going public, which is kind of happening per week or every other week here. And then the 80s with Apple and Genentech started to really explode. And then you had a lot of cycles. So this cycle, I don't think is any different than prior peaks. What distorts the data a little bit, and Mike and I will talk about this, is the explosion of these special purpose acquisition corps, which really balloon the data. You said 900. There's probably 400 SPACs in there. I'm just guessing. So the data's a little skewed because of this SPAC phenomena, and it's really a phenomenon. I mean, if you read your paper this morning, Kevin Durant decided to announce he's doing a SPAC, joining LeBron and everybody else. And if you, I'm going to explain SPACs, but for us, it's they're an exit release for us. There's a way to sell one of our portfolio companies into the SPACs. It's great for us because there's so many of them, and they all have a time deadline and when they have to make an acquisition. So the later they are, the more desperate they are, they'll pay up for our companies. there are a lot of people in our industry, Mike and my industry, are creating their own SPACs. And you can get into a debate. I've never talked to Mike about it, and I don't know how many institutional investors are here, but it's kind of, to me, it's a huge conflict of interest and something that shouldn't be allowed to happen, because we're all paid to invest capital, and now people are creating in our industry their own entity, raise capital to do more investment. It doesn't make sense to me, but we love selling into a SPAC, and we've never done it, but we're in the bottom of the ninth inning with one out on a SPAC exit for us. One of our larger companies, over 100 million of EBITDA, and we're getting a value that we couldn't get through any other exit alternative. And it should happen in the next few weeks. So SPACs for us are just another one of probably a half a dozen exit opportunities. Pure IPOs, we've made 120 investments in 23 years. 3 went public. So it's very rare for us. And it usually is some kind of special story. We were the initial investors, and this isn't what we do for a living, but one of our biggest hits was Five Below. We invested in Five Below. We were the first institutional capital in Five Below. And, we're the idiots who sold out in the IPO at about a $400 million valuation. Today it's 6 or 7 billion. So anyway, IPOs are rare for us, but we're at the low end of the food chain. We're creating companies that sell to bigger private equity firms or sell to strategic buyers. And we can get into, I can talk for an hour on this. I'll turn it over to Mike.
Yeah, we have a very similar theme, Graham. We're at the ninth inning of 2 SPACs. One should de-SPAC on the 1st of December. And one should be sort of the middle of December. I'll talk about it in a second. Like Howard, we actually consider doing a SPAC, and it's alluring. If you look at what the sponsor economics are, you basically should make 10 to 12 times your investment rather easily, regardless of how it turns out for the actual company at the end of the day. We came to the same conclusion Howard did. We just felt that it was a bit of a conflict of interest, and so we declined. We said, no, we're not going to do it. But we evaluated it all summer for it. Now, in terms of the 2 SPACs that we are doing, we viewed it as a financing opportunity, but what was very critical to us, we had one company that had 12 bids, another one that had 8, all from SPACs. And we didn't take the highest offer, but we took the offer that we thought had the best composition of cash, investments, et cetera. Then you go through the whole pipe process, which is another gate. Our pipe, fortunately, was led by Fidelity in the one SPAC that I'm involved with, and then got upsized after we had thought we closed it. The investors asked to add another 25%. So if you look at the cash on the balance sheet, there's going to be almost $450 million. Of course, that depends on how much redemptions there are for the initial group that went public, which is all these things you sort of calculate and try to underwrite when you're in the middle of it. We have never taken a company public. We did buy a stock in a public company. Many of you know of the name of it. It's Nutrisystems. It's ages.
Greatest investment ever done in Philadelphia. 62 cents
Yes.
to $80.
Yeah, it was a
Do
good
the
outcome.
math.
Howard and I used to teach a course about it
Right.
with at Penn Law.
We're the idiots who turned it down and referred it to Mike. So
They did. Seth
Right.
referred. Thank God.
we didn't like the
I
food.
said yes, supposedly on the 3rd page. Of the
Right,
deck,
yeah.
But I will tell you, though, it was really odd. The company got to $780 million of revenue, $170 million of cash flow. And for the last 6 quarters of board meetings, we talked about our stock price, not about how to build the company. I thought it was the most, when I got off the board, we were sold out. It was a great outcome. It just, the bittersweet piece of it was you spent more time talking about activists, shorts, and you don't talk about building the company. So you really have to know what you're doing. I found it to be a pretty thorny environment. So I'll be interested to see how these 2 SPACs will do, because I'm staying on the board of the one.
I want to shift gears a little bit, but just thinking about these liquidity events that IPOs or SPACs represent, and just thinking more broadly about liquidity, for your clients, and how patient they are as investors. Looking at the difference between public markets and private markets for liquidity, Is that a conversation that you have with your clients? Are they worried about that, or are they so patient that they're fine with being locked into a 10-year private equity fund or whatever closed-end fund?
Yeah, actually, almost the opposite. So, our client base is ultra high net worth, and so we're talking about generational money, and we're a lot of the assets that we manage are in perpetual trust that are skipping generations. So we've got the opposite issue. We don't want our money back, and actually we talked a lot about and having PE fund that are perpetual. One of the issues in the business, and again our model is a little different. We don't charge a carry. There's no incentive fee, so we don't have an incentive to have an exit. And what happens in the PE business is, the only way they really get paid is to have an exit. And I'd ask the question, how often are those exits timed to the liquidity needs of the fund versus the best opportunity for the investment you make? So more and more and more, as our business grows, we're doing control private equity investment that we own and control, or we're doing deals with sponsors where we have the ability to buy them out because they need an exit. So liquidity for us it's the opposite. So there's a great firm in town. I don't know if many people are familiar with Berwin Group, and they took that model. There's a very wealthy family, and they took the model of owning the whole business. They don't want to invest in a private equity fund. They don't want to invest in public equities. They just buy entire businesses. And they do run and manage the portfolio, but the decision to buy or sell is really based upon fundamentals and their belief of the future. So our liquidity is, it's almost perverse for us. It's really hard to find a great investment. And then if they give you your money back in 5 years, like, oh shit, now I got to go find another one. So for us, if we could, and there are obstacles in the business, as everybody knows.
That's absolutely true. I remember when we were raising our second fund, it was easier because we had Nutrisystems, which was publicly traded, so we weren't as worried about an exit. But in Fund 3, we were worried about exits. Now we're on Fund 5, and our other strategies are on Fund 4. There's less pressure to feel like you have to return because you have a track record of having done it. So you try to optimize for the highest potential price and liquidity given the circumstances. But there is always pressure to create liquidity and get points on the board because that's our job. There's no doubt about it.
It's funny. Our business has changed as a public equity manager for tax-exempt institutions. We are required to provide liquidity. That is, we've become the checkbook for our institutions. And so one of the biggest things that we think about in this is how are we going to be effective at providing that liquidity via navigating the transaction costs and the trading costs that we have to face. So it's a careful dance that we end up having to play around that issue because we've essentially, like I said, become the checkbooks for our clients.
Yeah, I'll just add one other thing. Mike, I don't feel the pressure at all to get a liquidity event. I think the fact that we've been around for a while helps that. And, these funds, I was telling Mike before we started here, our second fund in 2004 is finally going to wrap up this year. So 17-year run. But it's a different kind of investment thinking process. A Buffett or the Berwin family, Graham Berwin when he was alive, they're thinking forever. And we can think long term, but for us, forever is maybe 10 years. And we've owned businesses for 10 years. So we have a lot of runway to create value, but it's always nagging there. Our LPs never say, hey, sell. They don't want to be involved in that decision, and they're not as anxious as we think they are. But we have more of a 10-year horizon when we think about stuff than a forever horizon.
We just sold a company together that I think was 7 years for you, 10 years for us. And we had multiple chances to sell it. And we just kept saying, no, there's a lot more value. It's a great business. Let's let it build.
And
But,
that's a
but,
good-
the, but the fact is, only 30% of private equity investments are held more than 5 years.
Yeah, well, we average about 5 years too.
Yeah,
That's what it
so-
ends up being, because you get these offers you can't refuse, or you just want to, you get tired of it and you want to move on.
But the other irony is, I think, and you guys have forgotten more about private equity than I know, but it feels like the business has changed, and where, right now, 60% of all private equity transactions are to other private equity funds. And I think if you go back, and ask somebody like Ray Chambers, when you bought a company, now one, the business has changed, the capital in private equity is stunning. The amount of dry powder, so the amount of buyers that we know there. I mean, just like your SPACs, we know they have to buy.
Yep.
These funds were not raised not to deploy.
Well, the other thing is that they know how to buy. So we have not sold 60% of our companies. I don't know what it's like for Howard to PE, but lately a lot more than previously.
Yeah, and that's last year.
Yeah, but they're much more organized. They're much more intentional. The certainty to close is a lot higher, and some are paying higher prices than a strategic. Strategic doesn't have a timeline necessarily, unless they have an earnings announcement and they have a burning reason to do something. So every deal we're in the middle of, there is a PE firm or two or three that's on the other end, potentially as a buyer. Is it the same with you?
Yeah. There's some real mega trends going on in our industry. And Ed, you touched on them in a couple different ways. One is there are more and more private equity funds being raised with a much longer time horizon, perpetual kind of funds. And that's a trend. I don't think our world will see that. Maybe they will. And you did a variation of that with Jim Mashtick, right?
Yes, that's correct.
Where he created a company that could go on forever. But there is this sense of more permanent capital because of the issue Ed mentioned, is we don't want the money back, the institutions, for our kind of piece of their overall portfolio. There's two other great phenomenons going on. Ed mentioned one of them. Because Mike and I are at the low end of the food chain, smaller companies, the private equity firm, I like to say Mike and I are in AA baseball. And there's a ton of players in AAA, and there's probably 20 or 30 in the major leagues. And they need to own our companies. And they become the great counterbalance to the strategic buyer. And about half our deals we're selling to private equity, or a private equity platform created maybe a few years ago that needs to bulk up. And some of the greatest growth investors in our country, TA, Summit, who are great funds, have been around forever, have grown so big, and they used to be known for their deal sourcing, but now they say, we can't get to companies before Mike and I get to them. We're looking to, you're our deal source now.
That's right.
We're their deal source because we've taken a company that's a bit rough around the edges, never been professionalized, we institutionalize it a bit, and then it's ready for big-time private equity. So we love that buyer. As Mike said, they have money, they move fast, and in some cases, which is so counterintuitive, they will pay more than the strategics.
Yeah.
It doesn't make any sense.
What do you think? What do you think about, think about public companies. So what do you think leverage is in public companies right now versus leverage in private equity?
We get a ton of leverage. Yeah.
My point.
Yeah.
And we're at a point now where we've seen increased credit availability and lower rates. So are we, not to take your job here, but are we at the end of a private equity cycle where the amount of leverage that we have available and the cost of that debt, because you guys said it, strategics aren't the buyers. Why aren't they the buyers?
Well, are we at the end?
I'm asking.
I've been saying that for 5 years or 10 years. Are we at the end? There's something though that I think, and I know I'll eat this word because I believe, one of the great investors in our world is a guy named Ray Dalio, Bridgewater. And Ray Dalio has like 4 principles. I'll forget the other 3, but one is the inevitability of cycles. And there'll be a cycle here, but we're in the salad days of private equity.
So we're not at the end for one simple reason. There's so much capital that's been raised that has been uninvested, literally billions and billions of dollars. I do think, and I've been saying this for years, valuations have been nuts. Clearly, if interest rates rise, and they're going to have to some degree, the pricing is going to change when companies go bought. We sold a company, which was really a great company called Internet Pipeline, which we had got involved with when it was $7 million in revenue. So 5 years later, it's about $120 million in revenue and really profitable. And we were running it to grow and to also be profitable. Thoma Bravo bought it from us for give or take $500 million, and they put $240 million of debt on it. And I just couldn't imagine that amount of debt on such a small company. It was 10 times cash flow. But it worked out incredibly well. They actually did another $80 million of debt for distribution, and then they sold it for $1.6 billion. Will they be able to do that in a higher interest rate environment? Not likely, not that number of turns. So I think valuations could get impacted. But there's just so much more capital that's been raised and continues to be raised for the foreseeable future. I don't think it's ending. I think valuations could change.
It's more capital, and the beauty is the capital has a 10-year life to it.
Yeah.
So it doesn't go away just because interest rates go up.
No.
And, like it or not, is we feel some pressure, although I try not to let it impact the investment decision, to deploy the capital because we're getting paid to deploy the capital. Yeah. But we have 10-year horizons, so we can take our time. But that money's not going away.
Well, Howard, I got to go back to this horizon issue because from a public equity market, I think one of the issues associated with the flow of capital into private equity and the lockup periods is the pressure that we feel, the shortening of the public equity market investment horizon tolerance. So at AJO, when we decided to return our clients' capital, part of that was that we're in the large value market, and the intolerance of our clients for a value cycle, extended, admittedly, value cycle, but the underperformance of value, I think, has a lot to do with the fact that their capital deployed and locked has to be preserved in that space, and they can't afford to take that risk or that horizon in the public equity market.
To add a little bit of color to the fact that funds are getting bigger and bigger, I read that the top 298 private equity funds in the first 3 quarters of this year raised $240 billion. So the funds just keep getting bigger and bigger.
There's $830 billion of undeployed private equity. $830 billion.
Yeah.
The funds are definitely getting bigger, and what's also happening, and Mike's done this a lot, we haven't done it at all, but if the funds start out with one fund family, like we're focused on lower middle market, sub 100 million in revenue mostly, private, healthcare, and technology. And what's happened is people are getting into other asset classes, debt, other industries, and it's become a multi-family universe. We're one family. You're probably up to 3?
5.
Five.
5 now.
So that's given the size, and then the funds get bigger. And then the Thoma Bravos of the world, they just announced last week they're raising $28 billion. They used to be, and we used to co-invest with them in Profit 21 and Yardley 20 years ago,
right,
with Orlando, who's now, multi-billions personally. And he says, well, okay, so Thoma Bravo's become so big in software with their main fund, but they created 2 other fund families within the same sector. But one's for middle-sized deals and one's for small deals. Forget the names of them, Explore and Discover, I think.
But here's the pressure, but you guys have done it really well. The pressure is on talent, on HR. I mean, you have 93
people,
right?
Yeah.
And you have an HR person now, you have a talent acquisition person, you have training. Yeah. It used to be 25 years ago, you'd have 2 or 3 partners and a couple of associates, and the partners just did everything. It was a bit mysterious. Today, to survive, you have to have a real corporation, effectively, with training, with evaluations, with mentoring, or you just will not make it. So I think funds will continue to grow in size, or fund families will, but the limitation will be talent, HR, and how do you build a real business, which in the past wasn't quite the goal. It now is, I think.
Is there any connection there to the public, the big mutual funds? So I'm just thinking of Vanguard, who's in our backyard here. I don't know how many trillions of dollars they're up to, but is there any connection there between also some of these index funds, mutual funds that have just grown so massive? Maybe it's different, but.
Go ahead.
Well, no, I think that one of the issues that we're all kind of bringing up, or you guys are talking about, and what you're talking about here with that is this notion of capacity. And sort of at what point does a particular strategy or asset class hit their capacity, or at a manager level hit your capacity, and then what happens and what's the effect? And ultimately the effect is on the client. You're either becoming the index, and so you're not adding active value over that when you're an active manager. If you hit your capacity, your inability to continue to find space to add value becomes a challenge. And so, ultimately, in an asset gathering environment, the one making money in the gathering of assets is not the client. And so the clients will start voting in a different way when they're no longer getting what they're expecting out of that strategy that's reached capacity.
I wonder if we can change gears a little bit, because I see that we've got 15 minutes left here. But I wanted to talk to you all about access. So for regular people to be able to get access to your funds, and I mean the answer may be that it doesn't apply to this crowd, because I know, Gina, you're working with institutions; those are tax-advantaged accounts. So in that sense, I guess people do have access through their pension fund. But on the private equity side, I mean, is it that you're at capacity anyway, and there's no desire to kind of raise capital from individuals? I know that there are sidecars involved in these funds, and if you have a really good relationship, you can get into these hard to reach funds. But is there any desire to make your funds easier to access for retail investors, or not really?
Let me talk to that for a moment. I'm sure, Mike, you can add something. The major league players, and I'll take Blackstone as an example in private equity. So Steve Schwartzman is on record saying that he believes the future asset gathering is among the retail investor, because the retail investor has so little exposure to private equity, and they should be there. So a big group like Blackstone is very focused on that. And Apollo just announced in the last week or two they're doubling, I think it's anything like 40 people, just to go after retail investors. And the Vanguards of the world are creating vehicles to put into private equity. So the retail investor, I think, is going to be developing access to private equity. It's going to tend to be the brand names, and the brand names are fine, and they do great, and that's why they're around, that's why they're brands. But I'll bet you Mike's returns and our returns are better, because it's easier to be better at the lower middle market than at the head.
When you say retail investor, are you referring to accredited investors, or?
I don't know how they qualify them, but they're taking 50.
Blackstone, you're being an accredited investor. The thing that's changed is missing. 10 years ago, I could not invest in Blackstone. Today, everyone can invest in Blackstone because they're so big, they need to go through distribution.
Yeah.
So they're going to go to Morgan Stanley, and maybe I'm going to pay 50 bips extra to invest $1 million instead of $20 million, and I'll do that all day long.
Right.
So it's actually very good news that these large funds are so big, they have to go through distribution. I would call them to the retail sector, to wealth management.
Well, yeah, I mean, they're not going to the.
Retail, you have to be careful.
Yeah.
These have to be accredited.
Yeah, these have to be accredited investors, but there's a lot of accredited investors who can't access private equity, and they're being given the tools like you
Yeah, but
just said.
I'll give you a tip. Just go buy BX. It's actually outperformed their fund. I'd rather own the GP than the LP, and you can buy that. You can put $1,000 in it if you want. But a great stock. I don't know if anyone pays. The dividends are unbelievable.
All of them have performed great, and I never got to the third mega trend in our industry, which is exactly that. So what's happened is that the public markets, in our cases, billions of dollars of capital have been raised in funds by Blackstone and others just to invest in the smaller private equity funds. And this is a big thing. almost every, not almost every, but many, many funds, and we keep resisting it, I think Mike's keep resisting it, are knocking on our door and saying, keep what you got, but we'll monetize the next 25, 40 years of your ability to raise capital and deploy capital and own a piece of your future. Yeah, and that's a mega trend in our industry. I think probably looking out 20 years, you're going to find that almost every private equity fund has sold a piece of its management company and carried interest to somebody else because people are monetizing that value today. It's crazy. I don't believe in that one either, frankly. I don't think we'll ever, at least while I'm there, we're never going to do it. Because it creates a different dynamic among your people. You sold off a piece of your future to another institution. What do you tell the person who just started with you about the future? And you know, all my partners are equal in management fee and carry. And that's what we strive for. We want equality. We want to bring everybody up. And you don't give away your future just because you've made a lot of money. So I think you're going to see more and more of that, and going public too.
Yeah, there's some that have gone public. I want to get back to the retail thing, to Mike, your comment. There are some groups. There's a local group who's done very well that has sold retail through commission-based organizations, credit products, and with big fees in a number of places. And I do question that. You know, in an interest rate environment where they can underwrite and get some decent interest rate, it seems to be working. But what we all do is not for the faint of heart. And there are quite a few high net worth investors that that don't understand sometimes when they're an investor in a vehicle like what we have. I've had a few, and those conversations are not, they're painful conversations when you realize you're misaligned, that they shouldn't have been an investor. That said, I do think that the notion of going to high net worth investors will become increasingly prevalent, particularly with groups that are SEC registrants that have good brands, maybe not at the size of the Blackstones of the world or the Sequoias of the world, number one. Number two, I think we're going to see a lot more products out there for high net worth investors and institutional investors from private equity firms and or growth funds, like co-investment vehicles, you know, pro rata vehicles, continuation vehicles. There will be a continued set of things. We did a continuation vehicle, which I'd never heard of a year and a half ago.
And explain it to everybody.
Yeah, continuation vehicle. It sort of gets to the issue that Ed brought up. We had a bunch of assets in our third fund that we thought could really go long, and one of which is going into a SPAC. And so it turned out we were right in that regard, one of which we were taking public, which we did. I said we didn't take it public, but we merged it with a public company. We own now more than half the public company. Anyhow, we had a timeline. Some of our investors may have wanted their capital back. These are institutions. We don't get pressure from high net worth investors. We do get pressure sometimes from institutions that, for whatever reason, have some form of requirement. So we offered, we brought in a buyer who placed an offer. Number of offers that came in. We offered it to our LP base. Anybody that wanted to leave could leave. The buyer wanted us to monetize 100% of our carry, which was about $50 million for us. I declined 100% of it. I said, no, we're going to roll. We're not going to sell one penny of our carried interest because that's misaligned. I don't want our departing LPs to think we want to depart because we want to stay with these companies and see it through. So that is going to proliferate. You're going to see much, much more of that. And so we extended the clock another 5 years for those assets, which were 8 companies that we had in that particular fund. And that fund looks like it'll be a 3x net fund now. Had we sold them prematurely, probably would have been about a 2.3, 2.4x net vehicle.
So we looked at investing in funds like that, and we have not been able to get over the hurdle of what's the valuation when we come in as a secondary. You know, when you invest in a fund, a de novo fund, you put $1 in, you got $1 invested. But when you invest in a perpetual fund, somebody's got to put a mark on it. And, you know, for us, every time we looked at it, you know, we didn't agree with the marks.
So and markets are very smart, and maybe markets are very smart. The typical person says, oh, private equity is a short-term horizon, and there's pressure to get out. But now 2 things have happened. One, we can take an asset in our fund and sell it into one of these continuation funds, we can go another 5 to 10 years. So we can go. And the second thing that's happened is the institution that wants to get out of Mike's fund, there's an enormous tens of billions of dollars of capital that's been raised just to buy private equity interest and create a market in funds.
It's very fluid.
So there's the time horizon is off as far as I'm concerned. If you want to get out, there's a fluid market created to buy your interest in the fund. And if you want to have a longer hold, you do a continuation fund.
And
So
Graham,
to me, there's no time horizon.
I think that's one of the things that could change. So we've actually started our own internal secondary operation, where we're looking to buy secondary interest in LPs. Again, looking to save money, right? Think we can buy, $1 for 90 cents. And I think that is something that will continue to grow and could create more liquidity and could create more opportunity. But the one part that you mentioned about you're willing to pay 50 basis points more all day long, that's a difficult one for us to swallow. I mean, we want to pay 50 basis points less all day long, almost in everything we look at, either the fee, the carry, whatever it is. Because after a while, you look at these returns, no offense, but 2 and 20, that's a lot. And I'm the one that used to get it in a hedge fund, which was stealing money. But
What are you willing to pay for diversification? I'm willing to pay a lot. 50 basis points is nothing. I've been in every one of his funds, some LR2, new investor in here, probably in 80 different VC private equity funds. It delivers a very, very consistent return. I have to go. Now, one comment on your point, which is there really is a huge opportunity in secondary because if you look at the endowments, for example, the pension fund, they have allocation models. They can have X percent of their assets, let's say, in private equity. And you guys are doing so well, they're going up. They have to sell.
Here's an interesting point to accelerate that.
There's been secondary funds like Newberger, Berman, forever that just bring that stuff up. They know they're buying at a great price, and people invest in it benefit.
So to amplify your comment, Mike, thank you.
Good to see you.
Good seeing you.
You should be on the panel.
He took a hobby and made it a company that's in like every golf course in the world.
Greatest entrepreneur in Philadelphia.
Yeah. So as it relates to that issue, there's one of the state pension funds was one of our investors. They were required to sell if made an offer. It was amazing to me. And I said, so wait a minute. There is no decision. They said, no, we have to. That's part of our investment committee requirement. So had the offer been cheaper, they would have been required. I thought, geez, it's unbelievable. But nonetheless, they sold in the continuation.
I got to say one thing here because I want to, when I come back in my next life, I want to be a private equity manager. Our fees at our strategy are at max, and this is in higher alpha, but maybe not this high, but harder to trade strategies. We're charging 80 basis points. Just 80. So on the 2 and 20, I can pick up 120 basis points for our clients just based on the fees that we're charging, and we're able to get in the public equity markets. But at 80 basis points, that's where we sit, and looking at what can we provide our clients above that rate. So that's the pressure that we face. It's, well, can you get above 80 basis points? In a market that's at 15, and so we're looking to be active above benchmark in a 15% annual return market. It's a different spot than you guys are in.
It's different.
Yeah.
But the markets are great, and they work so well. They've solved this perpetual issue in 2 different ways. But the bigger institutions are driving different 2 and 20 structures for us. We're not 2 and 20 on everybody. If you got 200 million, we're giving you a different deal.
Well, we're the same. We will also trade off fees for higher carry, which we've had some institutions accept, so a lower fee, but a higher carry, which we prefer, frankly.
Yeah, we probably pay for private equity. We probably pay about 1 and 1.25 and 15 is probably across the board. And in public equity, don't mean to ruin it for you here, but we pay about 32 basis points across our portfolio, and that's 70% active. So listen, scale is critical.
Yeah. It's definitely night and day. I'm glad you brought up secondaries because that's actually where we got our start was running trading platforms for private companies. It's one thing to do it at a fund where there's tons of demand. It's another thing to try and help a growing company that maybe has some employees that have left and they would like to get out where there's actually more supply than demand. That's a very challenging situation to solve. But that's probably the topic for another panel.
Well, the thing is, if you're going to be in secondaries, you've got to really, and you know, I brought this up, you got to really be careful about the marks. I mean, it's just, I'm on a number of endowments, not-for-profit investment committees, and we have private, you know, alternative asset portfolios, and I'm always interested in seeing what the marks are and how those marks are derived, because we're all given a fair amount of flexibility. Like at NewSpring, and it hurt us. At NewSpring, we've only ever sold 2 companies that wasn't at our mark or higher in our history. The average has been an uptick of 40%. And we've been criticized that we keep our marks too low by our LPs, who are often graded by how their portfolio is going. But we've wanted to be conservative and careful and that sort of thing. So it's quite an art out there.
That's a Philly thing.
It is. Yeah.
We're the same way.
Not out west.
By the way, you don't have the excuse of having been an accountant for 26 years.
That's true.
But we keep the marks down. But that's one of the. Let me tell you something that really worries me, because the returns are coming out for the Harvards and the Princetons, and everybody's crushing it because of private equity and the alternatives and the markets too. But they're showing 50% returns. And a lot of these endowments are in these venture funds.
Yeah, it's BS.
And they're marking it. I don't believe the marks. I think
they're marking up the price, but there's all these preferences.
Yeah, so I think the point is, when these returns aren't realized returns. They're based on, I think what we're going to find out are marks that are reflective of the market today. I just don't think they're sustainable marks. No. Because there's some crazy valuations going on, not in our world. They're crazy in our world too, but not as bad as that world. But you know, when you look at a company without much revenue and losses, and they're getting huge values, how sustainable is that? But that's another hour.
Yeah. I want to take a moment and see if there are any questions that the audience has. I obviously have lots, but anyone? Yes.
Curious about your thoughts on the fee structures in public versus private, and obviously the markets have chipped away at both of them over the years. But do you see a reason why they converge, or a reason why they don't converge over time?
I don't see them. I think they will never be equal. They shouldn't be equal. I mean, we have 93 people of very high-priced talent. Half of our firm is a consulting firm, just helping companies be better. So it's a different world. The word isn't active or passive. We're like, it's
overly
not
active.
Overly active.
Yeah.
I mean, we're living these companies. We're talking to these companies every week. So it's a different investment required. You're paying for that, and hopefully we can generate better returns. So, but it will narrow, but I don't think it'll ever the aperture will never be as narrow as maybe you might define the word narrow.
I think too, back to that point, it's dependent upon the returns that clients
That's
are able
right.
to realize.
Yeah.
And that fee structure, what we've felt in the public equity market, you're right, Ed, 80 basis points is tough. Emerging markets, small cap, 80 basis points, we can get that. But in our large value work, the pressure to be below 30 basis points in an institutional equity market was significant. One of the ways, we talk about 2 and 20, an approach that we've taken is to be 0 basis points in performance-based fees with a 30 basis point target. And so the goal for with a 0 base for us is to align with the clients, and it's become essentially an effective strategy. And I think it's where the industry should go, at least in the public equity markets.
Yes.
Have you all, probably Howard and Mike would have the best answer for this, but have you all felt pressure from any of your LPs in diversity hiring within your own?
No.
Your own firm?
No, there's none of that. There has been some interest in a thing called ESG, which sort of gets to that, but a more broader concept to have an ESG policy and so forth. A lot of that from Europe, which we have, but I have not had any pressure for diversity.
We've had more than
Have
we've
you?
had pressure. we have a lot of money from public pensions, and we have a lot from the City of Philadelphia's pension plan. And when you present to the City of Philadelphia's board, 90% of the discussion is diversity, which I endorse. So we feel it. And we don't feel it as much from them as from within ourselves. You know, until 5 or 8 years ago, we were a dominant white male firm. We had 13 interns, many of them become full-time employees in this last go-round. There was not one white male in the group. So we're forcing the issue, not because our institution said to do it, because we want to do it, and this is a personal view, it's the right thing to do. And I believe that with proper mentoring, you can take anybody and make them good. So we're doing it. And we're going to try to do it. We haven't proven anything yet, but over the last several years, we're going to make it work. And I don't even think you need a business background to do what we're doing. You know, as long as
judgment. It's about judgment.
It's judgment and energy and passion and how motivated you are, which wins.
Yeah, we do have some pressure on the types of companies to invest in. There's a thing called sin stocks that some LPs are fairly energized around alcohol, tobacco, firearms, things of that nature. And some LPs will prescriptively say, you know, we don't want our money invested in those types of things. So we have seen that.
I'm flabbergasted by the fact that you said no
Yeah.
to that answer. We're right in the middle of just how our first closing ranks. We have some pension money, we've got a lot of endowment foundation money coming in, and you talk to Mercer, Cambridge, Allborn, Duff and Phelps, you know, all the due diligence firms that are representing these funds out there, and we're getting, you know, 5 to 7 pages in operational due diligence.
Are you?
Exclusively ESG questions, and in particular DEI principles about hiring and investing in our companies right now. And it seems to be their #1 priority right now. Almost.
Yeah, you know, Dave, we haven't had any of it, but you know, we have 3 partners that are female. We have brown and black principals, and I don't know. Maybe it's because we were there, like Howard. We were hiring, you know, we were focusing on it years ago. I don't know. Maybe that's why I've not
It
had.
might be it depends on who your LPs are.
That's true too.
You
Yeah.
know, but as you said, you know, we're all, you know, because Europe is a big market too. You're getting more European money. We, for the first
Yep.
time in our last fund, got big money out of Europe, and that tends to be
They lead it.
they lead the ESG discussion, and you can't get their money unless you jump certain hoops with respect to ESG.
As I'll just add on the ESG front, because it is one that we face regularly as well. Everything that we do in terms of speaking with those major consultants that you just named, we have to answer about ESG. And it's not enough to describe ESG in terms of how we operate as a firm, or even to talk about exclusions that we would make. We need to show evidence now of how we're incorporating ESG into the factors and the choices that we're making within our stocks. And the real challenge for us, again, as a quantitative investor, is we're relying on the information that companies are providing, and we need to see that consistency and that transparency about ESG, and there really has not yet been, despite attempts, the standardization in a way that you can, I think we feel, appropriately evaluate what we're getting and compare it across companies.
Yeah.
So
That's a very good point, because it's not so much ESG and DEI as it relates to LLR, the firm.
right.
They want to know, what are your portfolio companies doing? You know, we're sitting on 40 to 50 companies at any point in time. You know, tons of employees. What are they doing, and how are you making it happen at that level, which is more important than our lousy 93 people, you know, versus, you know, we have companies that have 3,000 to 5,000 employees. So,
And Europe's leading the charge in terms of public equities, having the factors for ESG also.
For
So-
sure. I mean, I think for us, governance is the easiest one to capture. You can look at information, and particularly if you're able to get into you know, the financials of a company and the governance of that company, that one makes sense. It leads into quality. It talks about the company management. So that's something that we've been tackling for years. The environmental side, there are more avenues to really find clearer information on the environmental side. But once you get into the social policies associated with a company, that's where it gets pretty gray and squishy, and it's a lot more difficult to capture.
Yeah, I'm on the board of a couple public companies, and since really a year and a half ago, the pressure is immense, and we're all reacting, accordingly, hiring, board structure. So it's a major issue. Listen, it's a great issue to have. I kind of look at this audience. I think there's 5 women in the audience. I don't know, is that your
You didn't
fault?
say the inverse. The rest of them are all white males.
Yeah. So it's a problem even when we hire. Right now, we've got 3 open positions. Anybody knows? Anybody that doesn't look like any of you wants to come and interview, please do. But we really do try to focus on, can we find more women? Can we find more minorities?
Yeah.
And it's very, very difficult to even get the applicants to show up, not even choosing. So it's an issue that we work really hard at.
Well,
Good time for one more. Yeah.
Like you made the comment about talent being a constraint HR issue. I just wondered if you and maybe other panels would agree, disagree, expand on that for a moment.
Well, it's all about the people. It may be a cliche, but that's true.
The area that
I mean, we can't find enough people. We'll hire everybody we can find that we can train, and we're ramping that up. We have 4 people in our firm, full-time employees, that do nothing but recruit talent for our portfolio companies. It's like 4 people from Heidrick and Struggles are working inside of LLR just to find people. And the pandemic has exacerbated that issue. Again, it's everything, the inevitability of cycles, it'll change. But, talent's the biggest challenge we face.
And the thing I was trying to communicate was, I think there's been a change in how firms like ours and mine look at talent internally, and I think it will be a massive change in the next 20 years for those that win. It used to be that you'd have 1 or 2, I'll use the term cowboy, cowgirl partners, who, for whatever reason, were good at finding an investment and figuring out how to monetize it. And they had a couple people that would support them. But when they left, the firm would be gutted. And invariably, if they became extremely wealthy, they would leave and move on to whatever things that they wanted to do, unless they were nuts like Howard and I want to stay forever. But I think to build a really good business going forward, organization with a private equity organization, you have to train, coach, mentor a whole team of people, whether it's from an intern or an analyst level up through partner, because you have to continue to build that internal group. And I not many firms do it. Howard's firm has always been a leader in doing it. They have HR people for their internal organization. We hired a talent person a couple of years ago. We were always doing reviews and things of that nature, but it was not nearly as good as it needs to be. And 20 years from now, I hope it's way better.
I got to add something here, because 20 years from now, so one of my passion projects is education, and it happened to be a founder of a high school in Philadelphia called Revolution School. We have kids from 15 zip codes, and our aim is to have the kind of a program that's developing the thinking that you're talking about. So I've got a good source for talent for you for 20 years from now.
Well, I want to thank our panelists. For those of you who are not familiar with the Philadelphia investment community, these are 4 of the best minds when it comes to investments in Philadelphia. So thank you. If we can give them a round of applause.